Hello everyone. As we all know, in September, we have announced that QFIS and RQFIS can trade futures and options products listed on the Shanghai Futures Exchange. This marks the milestone of further opening up of China's futures market. And now it's my pleasure to give you a brief introduction to both SHFI's corporate futures, as known as CU, and INE bonded corporate futures, which is known as BC. Before moving to the contract specification and the rules, here are some overview of corporate and corporate futures contracts. As the most consumed non-ferrous metal in national economy, copper is of the industrial and financial nature and known as Dr. Copper. And China is the world's largest producer, consumer, and importer of refined copper. CU Futures is the first product listed on SHFI. And after nearly 30 years of operation, it has become one of the most mature products in China's domestic futures market. Its price has become the pricing benchmark for domestic copper trades. SHFI, together with LME and COMEX, is among the world's three major pricing centers of copper. When it comes to BC Futures, it has also created many firsts. It was listed on SHFI's international platform INE 2 years ago. It is China's first non-ferrous metal product accessible to overseas investors. It is also China's first futures product that adopts a dual contract mode along with CU Futures. In the next 20 minutes, I will start with the basic of the two corporate futures contract specification, then present their differences and similarities in terms of main rules. And in the third part, let's take a look at brief report on their market performance. Let's start with CU contract. This table shows the major parameters and information of CU futures. For example, the product is copper cathode. The contract size is 5 metric ton per lot. The price quotation is yuan per metric ton. The minimum price fluctuation is 10 yuan per metric ton, and etc. In addition, CU Futures shares the same listed contracts, trading hours, and the last trading day with other futures products listed on SHFI. Currently, CU Futures deliverable standard is #1 standard copper under national standard. But SHFI has announced this year that the standard will be changed into grade A copper, starting from December 21st, 2022. This means the grade and quality specifications for CU futures will be consistent with those of BC futures, which will be discussed later. CU contract appendix mainly includes delivery-related specifications, like the delivery unit is 25 metric tons per warrant. It also details the quality specifications. For example, tolerance on each warrant is minus or plus 2%. Pound difference is within minus or plus 0.1%. Copper underlying each warrant must be of the same manufacturer, grade, registered trademark, quality grade, shape, and secured into bundles of similar weight. Besides, deliverable copper cathode must be of a brand registered with SHFI, and specific information on the designated delivery storage facilities is available on SHFI's website. When it comes to the standard contract of BC futures, to ensure the coordinated development of both products, we tried to keep BC futures consistent with CU futures in terms of the basic rules and specifications since its design. BC Futures directly adopt a grade A copper that meets the national standard or European standards as deliverable standard. Another difference is BC Futures is listed on Shanghai International Energy Exchange, as known as INE, a wholly owned subsidiary of SHFI. Therefore, BC Futures aligns with INE's unique features of international platform, net pricing, bonded delivery, and RMB denomination, and is subject to specifications and the rules of INE. As shown by BC Contract Appendix, BC Futures are largely the same with CU futures in terms of the delivery unit and the quality specifications. It is worth noting that the deliverable and registerable copper cathode for BC futures must be of a brand registered with INE or a SHFE registered brand recognized by INE. All the 8 existing designated delivery storage facilities for BC futures are located in Shanghai bonded area, while the designated delivery storage facilities for CU futures are all located in China within the customs border. This table gives a clear comparison of the two products. As we can see, we have different contract symbols. BC is short for bonded copper. They are different in listing platform, how pricing is quoted, delivery mode, and the delivery period. In terms of the participants, previously, CU is only accessible to domestic investors, whereas BC is accessible to both domestic and overseas investors. But now we are glad to see that both BC and CU futures will be accessible to QFIS and RQFIS. Besides, the two products are nearly the same in other details of contract specifications. To ensure the two contracts are operated in a fair, effective, and stable manner, SHFE and INE have developed trading, delivery, risk control, and other systems and rules. In the next part, I will recount some of the main rules for investors. I'll mainly mention several rules in upcoming slides. The complete version of other rules can be found on the websites of SHFE and INE. Firstly, clearing rules. We have set up an internal clearing department to be responsible for clearing futures transactions, managing margins, and preventing clearing risks. It's a two-tier clearing form, which means the exchanges clear trades for members only, and each futures firm's member clear trades for its clients. In addition, the exchanges implement daily mark-to-market. Margin is subdivided into clearing deposit and the trading margin. In general, the exchanges collect margin from both the buyers and the sellers at the certain percentage of the contract value. But the exchanges may collect trading margin from only one side for long and short positions held by a client in the same product through the same member. Nevertheless, a contract's trading margin requirement will vary based on different periods of trading. In this regard, both CU and BC futures apply the same rules. Their margin rate increases progressively based on the period's change. We can divide it into 4 periods, as of listing, from the first trading day of the first month before the delivery month, starting from the first trading day of the delivery month, and from the second trading day before the last trading day. Correspondingly, the margin are 5%, 10%, 15%, and 20%. Different from overseas futures exchange, we set price limit. As stated in the table, their range of price limit is within 3% of the settlement price of the preceding trading day. The exchanges may adjust the price limit and promptly publish the new one on the websites under those circumstances. Currently, the range of the price limit for the two products is within 10%. By definition, position limit is the maximum long or short position that the exchange permits a member or client to hold a futures contract. Hedging positions are subject to review and approval and do not apply in this position limit. When a contract enters delivery months, a client should ensure that all the final positions are in multiples of the delivery unit. Here, for CU and BC futures, these positions are in multiples of 5 lots. There are slight differences emerge for the two corpus product. It's a stable percentage-based and a fixed amount position limit for CU and BC contracts over its life cycle. For a future firm member, overseas special brokerage participant, or overseas intermediary, a percentage-based limit of 25% will be imposed if the open interest of a particular futures contract reaches or exceeded the threshold. The threshold for CU futures is 80,000 lots, and the BC Futures is 70,000 lots. For a non-futures firm member, overseas special non-brokerage participants, or clients, a percentage-based limit of 10% will be imposed if the open interest of the particular futures contract reaches or exceeded the threshold. If the open interest is below the threshold, the fixed amount limit for CU futures for the period from the listing day to the last trading day of the second month before the delivery month is 8,000 lots. For the first month before the delivery month is 3,000 lots, and for the delivery month is 1,000 lots. When it comes to BC futures, the fixed amount limit for the three periods is 7,000, 3,500, and 700 lots. Qualified foreign investors will be added into this table very soon. Both two futures applied a large trader reporting system. For CU futures, when the general position of a member or clients reach or exceeds the 80% of the speculative position limit, they should file the report before the market close of the following trading day. For BC futures, the reporting threshold is strict 60%. The exchange conducts physical delivery through centralized delivery or exchange of futures for physicals. Since some key points have been explained in contract appendix part, I should point out that two products have different deliverable brands and designated delivery storage facilities. As of end of the 2021, CU has 58 registered brands operated by 45 companies and 24 storage sites operated by 19 designated delivery storage facilities. BC has 51 registered brands operated by 40 companies and 8 designated delivery storage facilities, all located in the Shanghai bonded area. As mentioned above, hedging positions are subject to review and approval and do not apply position limit. Hedging positions are classified into two periods, regular months and nearby delivery months. It is noteworthy that hedging quota of CU or BC contract should no longer be used in revolving manner starting from the first trading day of delivery months. The next two slides are rules about forced liquidation and risk warning. These rules are largely the same for two products. The exchanges will force liquidate the positions of a member or a client. If those 6 circumstances occur, a member should carry out an forced liquidation within the first trading session following market open. Risk warning system means that upon the occurrence of any of the events set forth in the slides, the exchange may, when it deems it necessary, take the certain measures against the relevant market participants to warn against and mitigate risks. At the end of the second part, once again, I'd like to compare the two copper products. Except for their similarities, they are different in position limit, threshold for large trader reporting, deliverable brands, and designated delivery storage facilities. Furthermore, trader eligibility requirements are not applicable to CU futures, but to BC futures. The transaction fee for CU futures is higher than new BC futures. Also, the market maker has not been introduced for CU futures, but it was introduced for BC futures in order to bring in more market liquidity. Lastly, I will give a brief introduction to the market performance of the two copper futures. The chart on the left presents the trading volume and the open interest of CU futures in the last decade. During the last 10 years, CU futures has been ranked top among domestic commodity futures in terms of the trading transaction, and has long been ranked top 3 among similar copper futures worldwide. As of October 25, 2022, this year the CU market recorded more than 37 million lots in trading volume and more than 1.8 million metric tons in average daily open interests. The chart on the right presents the trading summary of BC futures. it shows that over the same period, the BC market had 4.7 million lots in trading volume and 100,000 metric tons in average daily open interests, indicating a trend of steady increase. Let's move to the price movement of copper. When we put last 10 years futures and spot prices together, we can easily find a high correlation between the domestic and overseas futures price and also between the domestic futures and the spot prices, no matter whether the prices are at low or high point. The price of copper futures have become the pricing benchmark for copper spot trades. In the last decade, the correlation coefficient between CU and LME's copper futures price was 0.98, and that between CU futures and the domestic spot prices exceeded 0.99. In the less than 2 years after the listing of BC futures, the correlation coefficient between BC futures and LME copper futures price was 0.95, and that between BC futures and the spot prices exceeded 0.99. Physical delivery has long been an important function and means of futures products to regulate resources allocation. The physical delivery for CU and BC futures is smooth and well-resourced. Members can select the delivery types in view of market situation and their own needs. As of October 2022, physical delivery for CU futures amounted to 200,000 metric tons or RMB 14 billion yuan. For BC futures, recorded 90,000 metric tons or RMB 5.5 billion. That's all for my copper futures introduction today. Please feel free to visit our official websites for more information. Thanks for your time. Bye-bye.